All right. Good day, everyone, and welcome to our presentation on growing LGBTQ wealth. My name is Baptiste Brunner, and I'm a Texas-based financial consultant with Alliant, and I'm part of a team of professionals who give regular educational webinars. I'd like to start by thanking all of you for taking the time to join us today as we explore the financial power and unique needs of the LGBTQ plus community. This presentation will be about 25-30 minutes long. So with that, let's begin. Here at Alliant, we actually have a wealth of educational resources available to help you navigate your financial journey. And our team at Alliant Retirement Investment Services, we're focused on helping you understand the ins and outs of investing, saving for retirement, and much more. So take a look at our website. That's ARIS, A-R-I-S dot AlliantCreditUnion.com to see our list of weekly webinars. We have our podcast, which is also called Invest Savvy. That's a plethora of knowledge there. And then we also have our blog and other financial resources as well. So today we're going to explore three key areas that highlight the growing financial power and unique needs of the LGBTQ plus community. And first, we'll look at how the LGBTQ plus community is emerging as a powerful financial force. Then we'll examine the unique circumstances, challenges, and priorities that investors in the community might face. And finally, we'll talk about how we can empower investors in the community to take control of their financial futures with confidence. To start, let's discuss how the community is a powerful financial force now. This isn't just a social movement anymore. It's truly an economic one too, and let's show you how. So here are some important facts about the community nowadays. Now, 9.3% of US adults identify as being in the community, and that number is still growing. And 1.6 million Americans are also married to a same-sex spouse. 20% of Gen Z adults also identify as LGBTQ+, and nearly 19 million adults in the community are now registered to vote. Also, married same-sex couples have a median household income that's about 11% higher than opposite-sex couples. And globally, the community holds an estimated $30 trillion in household wealth. So, after that, it's safe to say that this is a growing community with influence, voice, and economic power as well. All right, now let's talk about the unique circumstances and some challenges and priorities that investors within the community do face. Fortunately, times have changed, yes, but the world has become more accepting, but there's still challenges. And starting with the workforce, a quarter of LGBTQ plus workers in the US are still completely closeted at work. And the community makes up roughly 6% of the workforce now, but nearly half of them have experienced discrimination or harassment in some form or another. And finally, employers still aren't always required to offer medical benefits to same-sex spouses. Now, on the financial side, individuals within the community often face wage gaps and higher unemployment rates. Lesbian couples, for example, they tend to earn less than both heterosexual and gay male couples. But there's also a patchwork of anti-discrimination laws that affect housing and lending, leading to lower home ownership rates and much greater reliance on renting then. And these financial realities make it even more important to work with advisors who understand and can navigate these unique challenges. And on that note, I'd like to mention that you have an ally here with Alliant Credit Union. And the community encounters unique circumstances and challenges regarding parenting, retirement, and even healthcare. Uh, Community members who are parents, they may require experts who specialize in surrogacy and adoption, assistance that is truly needed as we see a growing amount of parents within this community, as there are now 5 million children with a parent that identify as LGBTQ+. Then There's historical stigmas that may have made it difficult to earn a living, access to needed services, and for retirement. And concerns include finding community friendly nursing homes, affording care, and having support from family and friends, even. Now, let's talk about how to empower the investors within the community. And truly, it's all about helping you gain confidence to take control of your finances. And these next few slides have some great charts, information, and tips. So please feel free to pull out your phone and take photos of the content. We can review it later, but there's a lot of good charts to reference back to. So again, feel free to reach into your pocket, grab your phone, take photos of some of these slides. We won't get mad at you for it. So through empowering, one of the key differences between a dream and a goal are the actions that you take. And you might hear me say this a few more times throughout this presentation, but I do it because it's true. So here's a checklist to help put financial plans into action. Start by just evaluating your situation, then managing your finances, making a plan then for your future, owning and protecting your assets, of course, working with a financial advisor, and that's another thing you're going to hear me say a lot, but also educate yourself and then review your plan regularly. It's important to review your plan to make sure that you are on track and you're working towards the goals and hitting the goals that you want to hit. So, starting with evaluating your situation, know what's important to you and plan how to make it a reality. So make a list of your priorities and values. Some of your priorities might be independence, peace of mind, future, retirement future, or maybe being a big part of charity and philanthropies. But then list your responsibilities. So do you have a mortgage, a car note, um, educational expenses, or supporting your elderly parents? But then lastly, list your dreams. So, what are your dreams? Do you want to retire one day? Do you want to travel, have a second home or a vacation home, or just any kind of lifestyle items? But list your dreams as well. So, consider your financial goals, your priorities and values, and then make a risk versus reward portion also towards the bottom. And continuing on evaluating your situation, examine your credit history. Um, do you check a credit report regularly? Do you have credit in your own name? Do you understand your credit score? Are you comfortable with your credit limits? How much do you owe and at what interest rates? Are you protected from identity theft as well? Um, are you making sure that you're also working towards just having better credit? Do you understand how your credit score is actually calculated too? But also make sure your insurance coverage is right. Do you have enough insurance in case that something happens to your car or your home? Do you have life insurance? Is your life insurance enough coverage to take care of your spouse or take care of you should the worst happen and one of you were to go? But again, check your credit history for accuracy and your insurance coverage as well. Review the costs and the terms of your current coverage with a qualified investment professional. But if you haven't yet, I highly implore everyone to utilize the free credit websites. I personally use Credit Karma. Annualcreditreport.com is another good website, but regularly check a site like this on a quarterly, semi-annual basis. It really will help you gain that financial freedom. And next on managing your finances, take stock of your net worth. So build your own personal balance sheet and do this by measuring your assets versus your liabilities to determine your net worth. So some examples of assets are, your bank accounts, investments, bonds, retirement assets, and then you also have things like your home and your car. Do you have any artwork or any jewelry of value? Any furniture as well that might be considered an antique could actually be listed as an asset rather than a depreciating item. But also look into your liabilities. So it's going to be your assets versus your liabilities, what you have versus what you owe in this case, what you own versus what you owe. So as far as liabilities go, what is your credit card? How much credit card debt do you have? How much more do you owe on your home? And how much longer do you owe on your home? Your car notes as well. Do you have student loans or any other debt? So, what you own or the equity that you actually have versus what you owe. And then also maybe even look into seeing if you can pay things off a little bit quicker as far as liabilities go. I can't tell you how much better it makes anybody feel to not have to worry about taking X amount of dollars out of every paycheck every month to pay off credit cards or a home, or not necessarily a home because that's a good debt to have, but credit cards and cars aren't necessarily. Cars depreciate in value. Credit cards charge you 30% in interest these days. Should be illegal with how much they charge in interest. But a home loan is a different story. That's good credit or that's good debt to have. But measure your assets versus your liabilities to actually come up with your net worth. All right, and then continuing on this note, just understand your liquidity and your cash flow. So build your own personal income statement. And in this case, measure your income versus your expenses to see if you have a positive cash flow. And if the number is negative, you may need to make some financial changes or in some cases some lifestyle changes. But as far as income goes, the money that you're bringing in, so your salary, if you have any investment income, do you have any rental properties? Are you taking in Social Security or dividend income? If you bring in any form of income under these categories, that's going to be on the left under income, and then measure it against the money that's going out in your expenses. So your expenses are then going to be your rent or your mortgage, your insurance, any of your necessities, of course, too, like your utility bills, food. Everybody's got to eat. Transportation. This is America. Everybody probably needs to have some form of transportation, like a car. Um, so just measure all of these expenses versus your income. And if you have positive cash flow, you're probably in a fairly good position. If you have negative cash flow, consider reaching out to one of us for assistance. And now, planning for your future. So consider reviewing your life stage and financial goals with an investment professional and develop an asset allocation strategy. So under financial objectives, figure out what your investment goals are. Find out what your risk tolerance is. Some people might be more conservative than they think, but if you're younger, you should be more risky. You should be able to go into more riskier investments because if it's a longer term goal, it's fine. You have plenty of time to take on risk and then, therefore, more reward. Come up with an emergency savings account. It's very important that everyone does that. Being someone who was affected by Hurricane Katrina, which is now coming up on 20 years, that was a massive thing that I saw a lot of friends and families go through. Losing your job and your home and not having a good emergency fund to live off of until you're able to get back up on your feet. Very trying time. So, again, make that a priority and one of your financial objectives to come up with a savings goal, but also list your investment goals and try to figure out your risk tolerance. We have a risk tolerance questionnaire to help you figure that out. But again, important there. But then also figure out some special circumstances that you might want to be best prepared for. So preparing for the unexpected events and just some contingency planning. Do you plan on caring for your children for a longer period of time than 18 or taking care of your parents as they get older? But also consider yourself too. Do you have any estate planning needs? And we're going to get into estate planning needs a little bit more as we go too. Continuing on this path, invest early and invest often. The power of compounding can significantly grow your investments over time. So in this case, we have the left side and the right side. If you were to invest in just a basic 60/40, and by 60/40 means 60% equities or stocks in this case, or 40% bonds, so a little bit more of a conservative investment. But if you were to invest in a fund that was 60% equities and 40% bonds from 2014 to 2024, and if you just did $10,000 but also contributed $100 a month, from 2014 to 2024, that would have grown your money plenty. But if $500 more, or instead of doing $100 a month, $500 a month, you can see the much larger amount of growth that you would have experienced. So again, Invest early, invest often. If you'd like to have numbers like this and have hypotheticals run for you on what you could do with money that you have and how you can grow money and grow your wealth, we have tools for that. More than likely, if you're on here today, you are a member of the credit union. It is a no cost planning review that we can do with you. We're happy to help in any way possible. Another important thing is to then diversify your portfolio. And a common approach is to divide investment options into your core investments versus diversifiers. So, core investments might be like investing partially in equities in the US, maybe some international funds where you're investing in Europe or maybe parts of Asia as well. Then there's also global investment grade funds, might be bonds or stocks. And then fixed income, that's going to be more of your boring investments, but your safe investments. So you might get something like 2 to 4% each year, but you have no risk. Whereas your equity is kind of your go-getter. That's where you're going to see the majority of the growth. And here you can see that this under core equity and fixed income, it's showing 60-40, similar to the chart, the example that we showed before. This is different. This circle chart here, this pie chart here, would be different for anybody. It just depends on what kind of investor you are, hence why figuring out your risk tolerance is so important. So, the younger you are or the more risky that you are, the more equity leaning you'd be. And as you get closer to retirement, more than likely you're going to be more into conservative or fixed income investments. But then also adding some of your diversifiers here in the middle. So that could be a plethora of different options. Different categories could include commodities. Do you like to invest in gold, silver, precious metals? There's funds for those too now. Then there's also real estate investment trusts, global public real estate funds. Of course, then you could be pretty risky if you want to invest in some of the tiger states like Southeast Asia and go into their riskier small cap equities. Then we have our emerging markets. That could be anywhere in the world. A fund that's created based off of companies across the world in emerging markets, whether it be somewhere in South America, West Africa in a lot of cases. It could be quite literally anywhere that's just an emerging, growing market in this world. But through that, you're able to create a diversified portfolio. And that's such a cliche to hear, diversified portfolio. But really, what it means is if you're investing in one fund, you could invest in just one fund and be very well diversified. It just matters if the fund itself is fully diversified. So, really, it's just important to have a large plethora of different categories and different stocks invested. So let's say that you have a technology fund that you're invested in, and Google and Amazon and IBM are in there. Well, if IBM's on the downslope, well, maybe Google and Amazon are able to pick them up. But if IBM is all you're solely invested in, then you're taking all the hits that IBM is. So I hope that just makes quick understanding of what we mean by diversifying your portfolio. Now, owning and protecting your assets. So, own the right investment vehicles and options, and consider consulting with an investment professional. We have 13 of them here at Alliant, and ensure that you're capitalizing on appropriate retirement planning vehicles. So, are you working for an employer who's offering you a workplace retirement plan, like a 401k? If you're in the private sector, a 403b. If you're in the nonprofit sector, like if you're working at a nursing home or if you're working at a hospital or a church, a 403b is probably going to be what's offered to you. Or if you're a teacher as well, are you in a 457 plan where you're working for a government entity? And sometimes you might be working for a company that offers both a 403b and a 457. Or do you have a pension offered to you? But are you taking advantage of these plans? If your boss, if your employer is offering you 6% match, are you getting all of that money? Are you contributing 6% to get all of that extra free money from your boss? Consider it as a salary bump or a bonus, pretty much. Just you have to contribute to match, but it's free money that they're going to offer you in the form of a match. Are you taking advantage of that? And if you're not taking full advantage of it, consider that. But if you are you also considering an IRA? or maybe a personal pension plan, or like an annuity. And then there's also those more individual retirement accounts too, but there's Roth IRAs, there's traditional IRAs, and again, there's annuities as well, but plethora of options out there. Everybody, there's no such thing as cookie cutter. And if people push cookie cutter strategies, probably not the best person to work with. But everyone should have a different portfolio because everybody's different. So get with an advisor that you can trust and to learn about all of these products. Again, I'd be happy to walk anybody through all these different investment vehicles. It's my job, and I'm kind of a nerd, so I'm very, very enthused to help anybody out and help them learn more about these different types of investments available. And now back to estate planning. So, protecting your assets through just smart estate planning. Create a will, and when appropriate, also meet with an estate planning specialist. Some of us do have attorneys that we work closely with to create trusts or wills for our clients, but we can help you in a large aspect of this entire process. So a will is one document that you should definitely consider having. Healthcare proxies, that's if you're disabled or if you're not able to speak for yourself, you're able to create a healthcare document that says what to do to you, what to do in the case that you're incapacitated. Durable power of attorney, same thing. That's when you're going to be giving away power to more than likely your spouse or just who you trust the most in this world. Guardianship provisions, and then, of course, back to trust. And to learn more about trust, please feel free to reach out to us. We're able to help. Healthcare proxies and durable powers of attorney, that's going to be something more on a state by state basis. But to get those taken care of, again, we can help you, but that's something that you can find on Google more than likely. So I'm in Texas. I can go ahead and get on Google right now and look up how to file a healthcare proxy or how to file a durable power of attorney. Every state's a little bit different, one way or the other, but more than likely, it's just going to be a form that you have to fill out and file. For healthcare proxies, for my clients in Texas, I tell them to have one for their hospital, one for their primary care doctor, one for whoever their power of attorney is in this case, or for their spouse. You should honestly God file a couple of these with multiple people. So really, in the case that the worst happens, or if you are incapacitated, there's really no question as to what your true wishes are. Next is working with a financial advisor. I know, broken record saying that over and over again, but considerations in working with an advisor include their communication style, their fee structure, their expertise, and their capabilities. So, as far as their style goes, do you get along with them? Do they communicate well with you? Are they somebody that you feel comfortable working with and that you actually can feel like you can trust? Are they attentive? Do they listen to you? And are they relationship driven? Because this entire business, I've been in it for 10 years now, this is a relationship business. You might not call your financial advisor your friend, but they're going to be one of the people that you're closest to, and you're probably going to have the second most confidence in that person after spouse and family. Capabilities, are they willing to teach you? We might go through 8 different investments, 10 different investments you've never heard of. Are they willing to sit with you and walk you through the ins and outs of these investments and how they work? Are they willing to explain every detail to you? And what is the range of their services? Do they know how to manage your risk? Do they know how to reduce your risk? And then fee structure. Some people say, okay, well, I'm just going to put 1%, 2%, 3% and wrap it around all of your investments. Some folks like to use no fee products where there's no charge outside of time. And I can explain that to you if you're willing to meet and try to learn more, but I'd be happy to go through that. But try to figure that one out. Everybody in this business has to legally disclose fees to you for any product that you're in. If they're not, that might not be the best advisor to work with, but ask about fees with whoever you decide to interview. Next, what's their expertise? How long have they been in the field for? What are their qualifications? What's their education? Do they have a good reputation? Do they seem to be knowledgeable and so on and so forth? But hey, interview your advisor. They're going to be managing your money. You're more than welcome to interview them, and that's a completely fair thing to do. Here are 10 potential questions as well to ask an advisor you might be interviewing. So, one is, do they have experience with ESG and impact investing? As a financial advisor, what do you do? What's your specialty? What services and standards can you expect from them? And then ask them about what their experience is or how long have they been offering financial advice for. Another is, what are the key components of their investment approach and how do they benefit you or do they benefit you? Another is also, what professional designations do you hold? CFP is becoming a more and more popular professional designation, but there's a lot of other designations out there that might fit your needs more. Of course, always ask your advisor, how are they paid for their services? If it sounds like it's free, it's not. We have to get paid. We still have to feed people too. But ask how they're paid for their services. It's not an offensive question. Ask them as well, do they follow a code of ethics or set of standards that you can review? More than likely, their company has that code of ethics and standards. They should be able to provide that to you. Ask them what proportion of their clients are LGBTQ plus or within the community. Lastly, relative to your life goals, what's the assessment of your financial situation today? And that can be prepared with a financial plan. We offer that at no cost. We'd be happy to prepare one for you. It's just going to cost you a little bit of your time and a conversation or two. But also educate yourself. Moving on, educate yourself, educate yourself, educate yourself. Be a smarter investor and stay informed by either reading financial publications, browsing financial websites, and again, working with an experienced investment professional. But it's hard to keep up with Financial Times. Every time I refresh Forbes or the Wall Street Journal, there's 50 more articles. I have to service clients. I can't read every article that comes up there. It can be intimidating. So, one of the best things that I can actually implore you to do is listen to our podcasts. We have 12, 13 advisors across the country, some in Chicago, some in Denver, some in California. Myself and another colleague, we're here in Texas. Among all of our advisors, we're offering 4 to 7 workshops or webinars every week. Join those. I showed you the website earlier. Our podcast, we have a plethora. I've used that word 3 times now today, but we have a multitude of different topics to go through. So find out ones that might interest you more. I'm doing one on the basics of investing soon. There's just a lot to learn. So if you're just starting off and you want to learn the basics, we have one that's on the basics. If you want to learn about annuities, we have one on annuities, one on tax strategies, one on how to save money in the future, one how to save and be prepared for retirement. We have a topic for everything to help you become as knowledgeable and educate yourself as best as possible. So feel free to join our webinars. Again, we offer anywhere from 4 to 7 every week. And then review that plan regularly. So we've been going through how to make a plan, review it regularly. So sound financial planning, it's not a set it and forget it investing strategy. It means engaging in regular reviews. More than likely, it's going to be at the very minimum once a year. You might want to consider doing it twice a year in that case, but consider reviewing each of the 7 steps at least annually. All right, so some of the key takeaways from today's presentation. The LGBTQ plus community is a powerful financial, economic, and political force, and investors in the community have unique needs and opportunities. But the key difference between a dream and a goal is the action that you take, and we can help you gain that confidence and take control of your finances. But by utilizing these 7 easy steps, you can put your plans into action. And again, thank you all for your attention today. If you have any questions or need further assistance, please feel free to contact me here. If you'd like to do a one-on-one meeting to learn more, take control of your finances, we're here to help. Feel free to continue taking photos. You can keep my face out of it. It's a terrible photo. So I apologize if that's appalling in any way. But I really do appreciate your attention and participation and hope that you'll take advantage of this information and resources that we provided. So again, thank you all for joining today, and we're here to help.